The concept of a BRICS currency has been discussed within the bloc for several years. However, as the alliance grows and economic pressures intensify, talk of a common BRICS currency has gained new momentum. Recently, at the BRICS summit in Kazan, the official BRICS website released multiple images showing a symbolic currency note presented to the president of Russia, who currently chairs the BRICS. This imagery has fueled speculation about the future of a unified currency, whether in the form of a BRICS-specific note, the yuan as a common currency, or another medium designed to reduce reliance on the US dollar as a global reserve currency. Before delving into the proposed banknotes' details and significance, it's essential to understand why BRICS nations seek alternatives to the dollar. The drive is motivated by both economic and political factors, as member countries aim to shield themselves from dollar-based fluctuations, strengthen trade links within the bloc, and gain greater control over their financial policies within a multipolar global economy. The US dollar's role as the dominant reserve currency dates back to post-World War II economic restructuring, especially the Bretton Woods Conference of 1944, which established the dollar as a central currency and created the International Monetary Fund and World Bank to promote stability in exchange rates and financial recovery. The Bretton Woods system pegged global currencies to the dollar, fixed at $35 per ounce of gold, further bolstering the dollar's status as international trade surged in the 1950s. Yet, by the 1960s, US deficits and gold outflows strained reserves, leading President Nixon in 1971 to end the dollar's gold convertibility, transforming it into a floating fiat currency. Despite this shift, global reliance on the dollar persisted. However, recent geopolitical shifts and economic strategies have prompted BRICS nations to explore a currency that could enhance trade efficiency and reduce dollar dependence, particularly amid sanctions and trade imbalances disproportionately affecting member states like Russia and China. The BRICS economies, which consist of Brazil, Russia, India, China, and South Africa, now surpass the G7 in terms of gross domestic product, GDP, when adjusted for purchasing power parity, PPP. This shift highlights the rising influence of BRICS nations in the global economic landscape. Currently, BRICS nations account for over 31% of global GDP, reflecting their growing economic clout, and represent more than 40% of the world's population. Together, these countries also contribute around 16% of global trade, underscoring their role as significant players in international markets. This increasing economic power has prompted BRICS to consider strategies for reducing their dependence on the US dollar in global trade, a movement commonly known as de-dollarization. By moving away from dollar-dominated transactions, BRICS members aim to decrease their vulnerability to exchange rate fluctuations and the potential influence of US monetary policy on their economies. For instance, recent agreements between China and Brazil illustrate this shift toward de-dollarization, as they now allow direct trade in each other's local currencies, bypassing the US dollar as an intermediary. The proposal of a unified BRICS currency is another significant step in this direction. Such a currency could facilitate cross-border transactions within the bloc, enhancing trade and investment flows by reducing exchange rate risks and reliance on the dollar. This measure would contribute to the economic self-sufficiency of BRICS countries, allowing them to exercise greater control over their financial systems. The move aligns with a broader global trend toward de-dollarization, as other nations and regions also seek to reduce dollar dependency, fostering a more multipolar global financial system. This shift is underscored by bilateral trade agreements within BRICS, such as China and Russia, Brazil and China, and India and Russia, trading in local currencies and reducing reliance on the dollar. The dominance of the dollar can result in US influence over financial markets and global economic policies. Reducing dependence on the dollar would allow BRICS to support a multipolar financial system, equitably distributing economic power and giving emerging economies a larger voice in global financial decisions. The concept of a dedicated BRICS currency is gaining traction as a tool to enhance economic integration among Brazil, Russia, India, China, and South Africa. This currency could take the form of a single physical currency, or more likely, a digital unit designed to facilitate trade and investment among the BRICS nations. Similar to the International Monetary Fund's Special Drawing Rights, SDR, which is a reserve asset that derives its value from a basket of major international currencies, a BRICS currency could be constructed as a unit of account reflecting the economic contributions and weights of each BRICS member. There is also considerable debate over whether a BRICS currency should be backed by tangible assets, such as gold, or remain untethered. Proponents of a gold-backed currency argue that this would lend greater stability to the currency, reducing the risks of inflation or devaluation often associated with fiat money systems. A gold standard would also signal a return to traditional monetary principles, reassuring investors and trading partners of the currency's enduring value. On the other hand, some advocate for a more flexible approach, suggesting that a BRICS currency should operate without direct ties to commodities. The creation of a unified BRICS currency could significantly streamline trade within the bloc by reducing the complexities and costs associated with fluctuating exchange rates and cross-currency transactions. As BRICS trade and economic engagement continue to expand, a shared currency would simplify transactions, lower currency conversion costs, and reduce the economic friction inherent in multilateral trade. It could also encourage more direct investment flows within BRICS by offering a stable, predictable currency for long-term financial planning. On a global scale, the shift toward diversifying away from the US dollar offers BRICS nations a strategic buffer against potential risks tied to US policy shifts, including sanctions and other regulatory changes that could adversely affect their economies. The dominance of the dollar in international finance often allows US monetary policy, sanctions, and geopolitical moves to have far-reaching impacts on countries engaged in dollar-based transactions. By reducing reliance on the dollar, BRICS nations could mitigate these external vulnerabilities, gaining more control over their own economic environments. Interest from influential non-BRICS countries, such as Saudi Arabia and Iran, highlights the potential appeal of a BRICS currency beyond the current member states. Many of these nations share similar concerns over the US-centric financial order and seek alternative financial systems that offer greater autonomy. The inclusion of a BRICS currency would provide these and other countries with an option to engage in trade and financial transactions through a stable, multilateral currency that bypasses Western-dominated financial systems. A BRICS currency would also signify a substantial step toward building a global financial system less reliant on institutions like the International Monetary Fund, IMF, and the World Bank, which are often influenced by Western policies. In contrast to the IMF and World Bank's lending models, which are frequently tied to economic reforms aligned with Western interests, a BRICS-led financial system could offer alternative financing and investment opportunities with conditions more favorable to the specific economic and political needs of member and partner nations. Such a system could encourage a multipolar financial landscape, empowering emerging economies to pursue growth and development on their own terms and foster a more balanced distribution of global economic influence.